Hello everyone, I'm Anthony Pastore. Welcome to UBS Trending. Glad you could be here with us. Volatility, uncertainty, and of course inflation. The new year is right around the corner, but investors are asking, is the worst behind us? In the year ahead, how can equity investors navigate these uncertain times? So who else better to have in the room with us than David Lefkowitz, our equity strategist from UBS's Chief Investment Office. David, thank you for joining us. Good to see you here. Equities, it's been such an interesting market this year, and we're already looking ahead to next year as we're halfway through December. So thanks for joining us and giving us your take on things.
Yeah, it's great to be here.
Yeah.
My pleasure.
So I want to ask you, David, certainly volatility and inflation, they have really been the major headlines and the drivers for the majority of the year that was. As we're looking back here, the question is, have we been through the worst of it? Now, if you look at the S&P 500, a couple of weeks ago, it started to trend in an upward direction. So the question is the bear market over?
Yeah. So I think you hit the nail on the head, Anthony, in terms of the driver this year. It's been inflation, inflation, and inflation, right? And we've seen the highest inflation rates since the 80s, 40 plus years. And that's driven a very aggressive response from the Fed in terms of raising interest rates. And obviously, we just got the latest inflation reading this morning, which was actually pretty encouraging. We started to see some more clear signs that we probably are very much past the peak in terms of inflation. Now, bear in mind, it's still running too hot. 6% was core inflation. And even if you annualize the last 3 months, we're still running over 4. So it's definitely moving in the right direction, but still a bit elevated. But I think from an equity market perspective, if this past year was all about inflation, I think next year is going to be all about growth, right? And what I mean by that is that this year interest rates went up, and that really reduced the value of basically every asset, from home values to stocks to everything, even cryptocurrencies to some extent. I think next year it's going to be more about, okay, well, maybe the Fed is done raising interest rates, inflation's coming down, but what's going to be the impact on economic and corporate profit growth as a result of the rate hikes that we've seen so far this year? And we know that monetary policy works with a lag. So that, I think, is going to be the open question as we go into 2023. So unfortunately, I think it's going to be, I don't think we're necessarily out of the woods. The other perspective I would add to this is that, stocks are up about 12% from the October low. When we look at other bear markets, or I should say every bear market since 1960, there's usually a set of conditions that we see at a bear market bottom. And in October, we didn't really see those conditions that we typically see. Usually, interest rates are going down before the bottom. Usually, the spread between stocks and bonds is widening. Usually, there's line of sight to a reacceleration in economic activity. We really didn't see those types of conditions at the October bottom. So it's certainly possible that that was not the bottom. And I think investors have to be prepared that we could potentially revisit those levels.
So not truly a comparable event is what you're saying to what we've seen in history, recent history anyway.
Yeah, look, you never say never, right? We operate in a world of probabilities. But if you compare the October low to every other bear market low, it is a bit of an outlier. Now, again, that doesn't mean we have to go back there, but I think investors need to be prepared that it could happen.
Well, then that begs the question then, what do you then expect for the year ahead, 2023, of course, and even beyond that? Because we like to look at the decade ahead, when we look at the markets, where we've been, where we're going. What are your thoughts there? And I know a lot of it has to do with corporate earnings, corporate profits. So where are you thinking we're heading in next year and beyond? Yeah,
so, just to cut to the chase, I think we're probably going to be looking at an equity market that's probably not going to do too much if you look sort of point to point.
Right.
Our year-end price target on the S&P 500 for the end of next year is 4,000, and that's basically where we are today. Now, I think you're going to see probably quite a bit of volatility. We know it'd be very unusual if stocks just kind of flatline for 12 months. That's not our expectation. We're very likely going to see ups and downs throughout the year. You raise a really important point about corporate earnings. We know that corporate earnings are the most important driver of stocks. The reason that stocks go up over time is because corporate profits usually rise over time. Mm-hmm. Unfortunately, all the leading indicators that we track are suggesting that we're going to see some contraction in corporate profits in 2023. We're penciling in a 4% decline in corporate profits in 2023. And so that's a somewhat challenging environment. And there certainly are risks that we actually do slip into a recession. I mean, I don't think we're necessarily out of the woods. Again, those lagged effects of the rate hikes that we have experienced this year, those are still going to be with us as we embark on the next few months and really several months. So we're not out of the woods yet, and I think investors have to be prepared for that. Now, we know the most important thing about being invested in the equity market is it's time in the market, not timing in the market. And I think it's helpful to think about the longer term, because we know it's going to be hard to predict these twists and turns in the coming months. So look, I mean, as we sit here today, I think it's reasonable to expect kind of a 6 to 9% return annually over the next decade. So, it's not bad. It's not super amazing at the same time.
That's pretty much on par with what we've seen historically with equities, generally speaking.
It's at the lower end, I would say. I mean, usually stocks are up 9 to 10% annually if you include dividends. So we think we're going to be at the lower end of that range. But look, the reality is that valuations have improved, but they're still a little bit higher than long-term averages. And when we look at corporate profits, they're now above long-term trends. So the starting point is not terrific. But I also don't think we're going to be looking at a lost decade, right? We're not going to be looking at a decade in the next 10 years where stocks do nothing. I mean, that seems pretty unlikely. So I think equity investors will make money. You'll do better than inflation. It's still probably the most attractive major asset class out there. But I also think we have to be realistic about what we can expect from the equity market.
Yeah, especially in the short term, as you're talking about. Well, then what about if we drill it down to individual sectors? We've seen energy, healthcare, consumer staples particularly truly outperform over the last year. Do you still expect that to continue? Are there any other equity sectors that you're talking to investors about that you would maybe recommend being invested in right now?
So those are the sectors we like at the moment.
And continue to like going forward.
Yes, and continue. I mean, I think, as we were just talking about, in this environment where we're going to see likely some disappointments on earnings, we didn't even talk about this, but our estimates are looking for that 4% contraction. The bottom-up consensus is still looking for 5% growth, right? So we do think we're going to see some negative earnings revisions in the months ahead, and that's still a somewhat challenging environment. So I do think you want to be defensive. In other words, when I say defensive, focusing on segments of the market that are less correlated with overall economic activity, and clearly healthcare and consumer staples are going to be top of that list. People spending on drugs doesn't usually change despite what's going on in the economy. Similarly, people are still going to need to buy diapers and deodorant and toothpaste, everything you find within consumer staples. So I think those are still good places to be. The energy sector is kind of interesting because it's been a standout performer this year. I think we have a chart here that's showing that. But if you look at the valuations, they're still pretty attractive. You can get a 10% free cash flow yield in the energy sector today, and the companies are returning the vast majority of that to shareholders through dividends and buybacks. And I think the reality is that we're on the 8th year of underinvestment in energy exploration and production, meaning we just don't have a lot of supply out there. So I think we're going to be in a period of relatively elevated oil prices for some time until we figure out how to reduce demand or increase supply, and that's just going to take time. There are other areas besides sectors. I think in this environment, we've got a bunch of themes that we think are timely. We're focused on high-quality companies with pricing power. Even though pricing power is beginning to diminish, I think companies that can still raise prices and protect profit margins in this environment are still going to be a good place to be. There also are companies that are leveraged to security, whether it be defense spending, cybersecurity, food security, energy security. Those also look interesting. And then, people don't talk about this anymore, but the infrastructure bill was passed over a year ago, and those dollars are just beginning to flow. Mm-hmm. There are a number of companies that are exposed to that, and not only the infrastructure bill, but the Inflation Reduction Act, which is really a green energy act if we really talk about it. If we really look at where where the spending is. So there are definitely pockets of the market that we think investors not only can protect portfolios, but actually earn a positive return, even in this, what we think is going to be a more challenging or still a challenging environment.
Right. Do you still think that this is a market for value stocks? I mean, they've outperformed growth stocks for most of this year, being 2022, and inflation historically favors value.
Right.
Is it still opportunity for value, or is growth starting to come back into play here?
So I do think it's still the right place to be by being overweight value. And I give a couple perspectives here. You're entirely right that when inflation is higher than average, that tends to benefit value stocks. Now, we just talked about inflation coming down, but it's still going to be higher than average. Mm-hmm. And in fact, I think we have a chart here showing that when inflation is greater than 3%, value stocks tend to outperform almost irrespective of the sort of where we are in the business cycle. That's kind of what this chart tries to show. So I think inflation is coming down, but still going to be somewhat elevated. When we also think about, when I think about the growth complex, I think there's still some challenges there, right? I mean, these were many companies that really benefited from the early stages of the recovery from the pandemic. And I would argue we probably saw some of the biggest excesses in the growth segment of the marketplace. And now we're on the other side of that, right? I mean, everyone rushed into e-commerce, digital streaming, video streaming, I should say, and digitizing businesses. So you have this surge of activity early in the recovery from the pandemic, and now we're seeing a fall off in that activity. And I do think we're probably not quite done with that. In other words, we're probably still going to be looking at some more challenging period for some of those growth companies. And then you layer on top of that, valuations have come down for growth companies, but they're still not cheap. And growth companies still trade at an unusually high premium to value companies. So when I put everything together, value companies are cheaper. They will benefit from what will still be a higher than average inflation environment.
Right, it's not going away overnight.
Nope. And they don't have these sort of the unwinding of the COVID excesses that many of the growth companies have.
Terrific. David, thank you very much. It's always good to get you here and get your perspectives. Of course, there's a lot to digest with so much going on in the markets, and obviously as we're ending the year, good to see where we're going to potentially be headed. Thanks for joining us, David. Good to see you.
My pleasure. Thanks,
of course.
Anthony. David
Lefkowitz, head of U.S. Equities here at the Chief Investment Office at UBS. So if you want more information on that year ahead report that CIO has out right now, visit the website, ubs.com/year ahead-exclusive. It's right there on your screen to take a look at that. Plus, you can follow us on social media. We're on LinkedIn, Facebook, and Instagram. Plus, all of our past UBS Trending episodes are available for you to watch on demand. And as always, if you do have any questions about your portfolio or anything that David and I spoke about today, make sure to speak with your financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone, and remember to keep your eyes on what's trending. We'll see you soon.